Assalamualaikum and hi everyone. Welcome back. This is the second part of the video on the preparation of the consolidated statement of financial position. And in the second part, we are going to proceed with the preparation of the working schedule as well as the preparation of the consolidated statement of financial position. As you can see, the question here is a question from the sample final exam question FAR320. That was the one in July 2021. It is a sample question. So let's look at what we have been doing before this. We are now going to proceed with the preparation of schedules. The first thing that you need to do is to calculate the goodwill. To calculate the goodwill, you start off with the acquisition or the calculation for the goodwill of the acquisition of the ordinary share. So you have to put the figures correctly here. So the figure here will be taken from the question that you are going to take is the one from the information here. So that look at what I'm taking here. So it is from here, the one which is the consideration transfer. This is the consideration transfer. What you have here, the one in this box are consideration transfer. So after that, you are going to put the adjustment or the information that I have earlier adjusted. Remember in our first video, we start off with the asset revaluation reserve. So earlier we noticed that land under information number 2 was being revalued, and the land was being revalued at a surplus of 100,000. Maybe you could recall this information number 2 that we have earlier done in our workings here, the workings here that I've provided here. Okay, these were the workings for information number 2. Right. Now you have to go and put your retained profit. For retained profit, if you see before the adjustment, retained profit was having a loss. It's a debit balance, so this is a loss. So that 5,000 will be included here, but you are going to adjust that with the motor vehicle, the deficit that you have on the revaluation of motor vehicle. That was the one that we have earlier calculated here. This figure here, 42,222, 42,222 is where you need to go and remove them in the retained profit, because this is the first or initial revaluation that gives rise to deficit. So that was adjusted in the retained profit here, and therefore the retained profit now has a debit balance, which is actually a pre-acquisition loss of 47,222. Now we proceed with the ordinary share capital. If you could still recall, under information number 1, you have been informed, if you check information number 1, that the general reserve will be utilized for the bonus issue. So I'm checking information number 1 as well as information number 7. There was a bonus issue that was made by Spicy, which is a subsidiary company, that declared a bonus issue of 1 ordinary shares for every 100 shares held using the balance available in general reserve. So therefore, we have already done that part earlier. So now I'm going to incorporate that into the answer template here. So the bonus issue, if you have calculated much earlier, you can check my previous video, was 10,000. So you have to add to the previous balance of the share capital in the subsidiary, and therefore the adjusted balance of the ordinary shares that you include in the fair value of the net asset would be 1.01 million. 1.01 million. Now, next is the general reserve. Remember, the bonus issue involved capitalization of reserve, and therefore the reserve that will be utilized is the general reserve. The general reserve that will be utilized, since there is enough balance in the general reserve of the subsidiary on the date of acquisition, all the bonus issue will be issued by making or utilizing the balance of the general reserve on the date of acquisition. So I'm taking the one here, the one from here. So I'm taking the bonus issue, and the bonus issue is being debited from the general reserve balance as at the date of acquisition. So we're not taking the one that was on during the post-acquisition balance. We are taking the one on the date of acquisition. So that has therefore reduces the bonus issue has reduces the general reserve down to 30,000 from 40,000. And therefore, the fair value of the net asset, would be the figure here, 1092,778, because you total up this figure, all these four figures here. And the non-controlling interest, if you can recall in the question, information number 8, the non-controlling interest is measured at the proportion of the fair value of the net asset on the date of acquisition. So therefore, we will take the proportion of the non-controlling interest and multiply it with the fair value of the net asset, which is 1092,778 multiplied by 20%, and that will give you 218,556. So if you total up this, then you are going to subtract 1092,778 from the total consideration transferred and the non-controlling interest, and that will give you a goodwill for the acquisition of ordinary shares of 325,778. Right. Next, we will proceed with the calculation of goodwill for the preference shares. For the preference shares, for your information, there is no goodwill, but let's just check what was the consideration transferred. So you can see here, the consideration transfer was 150,000. Put the figure here. And then you go and calculate what is the non-controlling interest in the preference share. That was 25%. So 25% here. So 25%, 200,000. So therefore, the figure would be 50,000. So if you total up, you get 200,000. You need to go and reduce that with the preference shares available in the subsidiary company. And the preference shares available in the subsidiary company was how much was it? It was 200,000. So therefore, it leaves you no goodwill. So therefore, there is no goodwill. The same thing should be done for the acquisition of the debenture. And if you have done that, you would notice that the debenture also have nil in terms of the goodwill. So therefore, if you have the time, please go and calculate the goodwill for the acquisition of debenture. Then the total goodwill now will be 325,778. And as I've mentioned earlier, the goodwill for the acquisition of the debenture was not shown here, but somehow the goodwill is having no amount, right? So that was the total goodwill coming from the acquisition of preference shares, acquisition of ordinary shares, and also it should include the acquisition of debenture. Then we will calculate what is the impairment loss, since the question gives you the impairment loss. And the impairment loss was 10%. So earlier we have done already the consolidation adjustment for the impairment loss. And if you can see, we have already debited the group retained profit with the impairment loss, and therefore that will have reduced the goodwill. So you need to go and reduce the goodwill with the impairment loss, and the impairment loss was 10% from the total goodwill. So that was 32,578, and the remaining goodwill was 293,200. And the impairment loss, don't forget, you need to include the impairment loss in the group retained profit column, because that will reduce the group retained profit with the impairment loss. It is an expense. The remaining goodwill that you will show in the in your preparation of statement of financial position later would be 293,200. That will be shown in the non-current asset. Then you will proceed with the analysis of financial statement, which is preparing the second part of the schedule, which is starting with the retained profit of the subsidiary. So first you take the balance as per the given in the statement of financial position, which is the balance here. This balance, that is 95,000 balance carried forward. Then you need to go and take into consideration the adjustment that you earlier did for your fair value of net asset relating to the retained profit that has a debit balance. Remember, I told you retained profit that has a debit balance is actually a loss. So pre-acquisition loss of 47,222. So because this is a loss, you're not going to reduce, you're going to add to the balance. Then you need to adjust with the revaluation deficit, which is the pre-revaluation deficit, the deficit that arise on the date of acquisition for the motor vehicle. Remember the journal entry we earlier did here. So if you can check, this is the one here, the one that you debit to the retained profit, spicy 42,222, and therefore that will have to be reduced against the retained profit carried forward before the adjustment, right? Next is regarding information 2. Information 2 that relates to the motor vehicle. Whenever there is a deficit, there is a need for us to do the over provision of depreciation. And since the date of acquisition here was, if you check, the date of acquisition was on 1st of January 2019. So therefore, the depreciation adjustment has to be done for 2 years. So this is the depreciation adjustment that we have earlier done. The figure was already done here. So it was 8022, and this is how you get it. So that figure, you need to go and adjust by adding back to your retained profit. So you add back 8022 because the depreciation has been over provided. So you need to go and add back to the profit, which means that you are reducing the expenses. Next one is regarding information number 5. Check your question. What is information number 5? Information number 5 is regarding the dividends. So if you recall, the dividends that you have in information number 5 was actually situation number 2, where both subsidiaries and parent have not yet provided or recorded the dividend. So therefore, you need to go and record. And if you have can recall, you have already debited the retained profit for the consolidation adjustment. And now we are going to incorporate the 2 entries here, this and this. And we're going to show that in the schedule. So first, under the subsidiaries schedule, which is a retained profit, this will be a reduction. However, that will be an addition to the case of the parent. So it was an expense of the parent, of the subsidiary, sorry, but that was actually an income to the parent company. To the parent company, that is an income, but to the subsidiary company, that would be an expense. So I'm putting this in red. So this one is also the same. What you need to take note here is that the part relating to the dividend here, what is shared by the parent company would be just 75%, since the acquisition of the preference share was 75%. So what was declared by the subsidiary was 20,000, but the parent recorded here. But however, in the case of preparation of the consolidated statement of financial position, this will not be reported. Remember, this is just adjusting or the adjustment for the items on the intercompany transaction. Next, if you have done that, so for the subsidiary, you are done. There are no more adjustments that will affect subsidiary. And therefore, if you total up the one that you have here, you would see that you will have 88,022. And out of this 88,022, the parent company, the group retained profit will have a share of 80%. 80% is because the holding percentage is 80%, and the non-controlling interest will have a share of 17,604, which is 88,022 multiplied by 20%, you'll get this, and 88,022 multiplied by 80%, you have 70,418. Go and take your calculator and check the balance. Next is the one of the parent company, retained profit of hot. This one is retained profit of spicy, and this is the one of hot and spicy. So the balance, as I said, this is taken from the question. The question means it is in the statement given here, 210. Right? You can also take the same thing for the general reserve as well as the general reserve of the subsidiary and the general reserve of the parent company, and straight away put it here like what I did now. Okay, here 80,000, and I'm putting another one here, which is the one of the parent company. So that was taken from the question. Next is information number 6. Information number 6, these are regarding debenture interest. So if you look at the information given, if you still recall what we discussed in our first video, you would notice that this is situation number 3, is the case where subsidiary has already provided and recorded for the dividends, and the parent company has not yet taken credit of its share of the, not dividend, sorry, this is debenture interest. It is not dividend, it is debenture interest. Take note that the percentage acquired in the debenture of the subsidiary was 50%. So if you can see here, there was a debenture interest payable declared of 8,000, right? 8,000. However, if you check in the current asset section, you cannot see any debenture interest receivable amount shown here. So it shows that the parent company, HOT, has not yet taken credit of the debenture interest receivable from Spicy. Right. So if that is the case, you need to go and do the recording. First, sorry. Okay, this is the one here. So you will record the debenture interest receivable from Spicy. Remember, in the consolidated, in the statement of financial position given here, it was 8. So you should take 50% since you acquired the debenture of 50%. So that would be 50% times 8,000, you have 4,000. So now you have the total of HOT, and total of HOT is 226,500, and 226,500, this will be included in the column of the column here was column for group retained profit. So these are the item or the amount that will be used to reduce the so-called impairment loss that you have had earlier here. So that will be adjusted against the group retained profit. Right. Next one is for the item here, you are done. So now we can go on with the general reserve. So general reserve balance was 80,000, as I mentioned earlier. And the pre-acquisition balance, 30,000 here, is the one from here. It is the one from here, the one in this working, or in the working for the fair value of the asset. And recall, this one is also, again, to show you, this is the one from, let me just choose a color. Okay, this is the one from here. Okay, next you can now find out what are the figure for the bonus issue. So pre-acquisition balance, meaning that pre-acquisition balance was the one that we took from the fair value of the asset, was 30,000. And then remember, there was a bonus issue that we debit to the general reserve. Yeah, so the general reserve was being debited for the bonus issue. This is the ratio 1/100/1,000, and the bonus issue was actually at 1 ringgit. Since you are not stated, so the fair value of the bonus issue was 1 ringgit, so 10,000. Now the post acquisition balance brought forward for the subsidiary company was 40,000, and therefore the share of the parent would be 32,000. Since it is 40,000 times 80%, the one of the subsidiary was of the non-controlling interest was 8,000. For the balance or the amount in the general reserve of the parent company, it was just 330, and you will include that in the column of group general reserve. So you are done with that, and you can now get the total for all columns that you will get it Here the non-controlling interest is 294,160. Check with your answer. 362,000 and 264,340. So what you will do now is you're going to show this in the preparation of the consolidated statement of financial position. So I'm putting what I have here first. 1, 2, 3 item here, and I'm going to put it here. What I have in my reserve section and equity section. So that you won't miss that. So now we will start our preparation. So the first thing to do is to combine. So when you combine, you are going to combine the asset that you have here, the asset with the one of the subsidiary, and you need to go and add them, motor vehicle with the one of the spicy, and you do not show this part because these are being eliminated. Inventories will be added, trade receivable, so you do be doing that, bill receivable. Loan, we are going to go and adjust and cancel with the one that you have under the loan from hot will be cancelled off against loan to spicy, and the cancellation of these two amount 15. What are the difference between the two? 15 and 13. The difference is 2,000. That will be treated as cash in transit. Then you will add this. The share capital, you will just report the one of the subsidiary, of the parent, sorry. The one of the subsidiary won't be reported because it is being eliminated. Same goes for the preference shares. No preference shares of the parent. If there is, please include. General reserve, these are from the schedule. These are from the schedule, right? Then this one must be included, right? So the debentures, you will have to take this and adjust with the one acquired by the parent. So you need to go and adjust something here. We need to do that. This one will be added. It will be added, and later this will be also adjusted with the adjustment for intercompany transaction. Let's do that. First thing is to do the combination. So I've done the combination part for all items that I have mentioned. So I'm going to show it now. Okay, so I add up the one of the parent with the one of the subsidiary first. So I add up that part, and I have put one extra row for the cash in transit. As I mentioned to you, the difference in the balances of the loan to and from, which is the intercompany loan balance, the difference of 2,000 will be regarded as cash in transit. Okay, after you have done that, you can now include the adjustment. So remember, for the first item, it was the surplus of the motor vehicle, 800,000. So you will have to add. So you have 100,000. So 200 plus 500, 700 plus 100, you have 800. And the second one would be the building. So for building, no adjustment needed because there was no revaluation whatsoever. For motor vehicle, there was a deficit, and there was also adjustment for the OPD, over provision. The goodwill that you show here is the goodwill that was the remaining goodwill, which you have here, the one in the schedule. The one here is shown here, the remaining goodwill after consideration for the impairment. For the inventories, you are going to adjust with the unrealized profit. We have done that in the first video, the unrealized profit. You debit the retained profit, you credit the inventory. So when you credit the inventory with the unrealized profit, that will have to be reduced. Trade receivable, you adjust with the intercompany balance of 15. That was from the one here, the one that you have in this the section with the green writing here. Those were the two things I just earlier mentioned. Next were the bill receivable. You need to go and adjust with the undiscounted bills. So the undiscounted bills were here, which is the one in the blue section here, bill receivable, where you go and adjust or eliminate the undiscounted bills. That was 75% of the bills were undiscounted. That gives 6,000. So that was 6,000 being adjusted. And bank, you just need to add up the balance given. So the total amount for your item here was 210,500, and if you add up, it will get you 2,679,500. For the ordinary shares, as I mentioned to you earlier, you just need to show the one of the parent, because the one of the subsidiary has been eliminated when you acquire the subsidiary company. For the long-term loan, you just need to add up, but nothing to add because it was just the one of the parent company. For the 10% debenture, this is the one of parent, so you just show it here, nothing to adjust unless the parent issued additional debenture. 8% debenture, the one of the subsidiary was 100, but parent acquires 50%. So the one acquired by the parent will be deducted, leaving the balance to be 50,000. So this one is being deducted by when it was acquired by the parent company. Next, trade payable. So you have to adjust trade payable with the intercompany balance. Remember the one that you adjust in the intercompany balance for trade receivable. Debit, trade payable, credit, trade receivable. Bills payable was the undiscounted bills. Debenture interest payable, remember what you have here is the one that you have here. Debenture interest, 10 plus 8. Yeah, 10 plus 8. And then you need to go and remove the intercompany debenture interest of 4,000. Remove it because these are intercompany transaction. The same thing will be done for the preference dividend. First, you declared that was an expense to the subsidiary, but later 15,000 was shared by the parent. So what subsidiary would report is the one payable to the non-controlling interest, that was 5,000. So then you have 131, the total of the current liabilities. The total of the non-current liabilities was 428. The one here, the total equity was 2,120,500, and here 2,679,500 is the total of the consolidated statement of financial position, the equity and liabilities. This is the one of the asset section. With that, that's it. I have finished with this, so I'll see you when I will see you. Go and practice more so that you can have a better understanding of this topic. Practice will minimize your mistake if it does not lead to perfection. But the point is you have to keep on trying. With that, thank you for watching. I'll see you when I will see you. I'll see you in my next video. Until then, bye bye and Assalamualaikum.